Hello and welcome everyone to this week's installment of the Bar Smart Repay Smart system, mindset, skill set, whatever you want to call it. Let's see, I'll bring up the PowerPoint here today. We don't have a guest speaker this week because I did not procure one. I was out last week, so we'll have somebody on our next series, which will be the week after next, after Thanksgiving holidays. Hope you all have a great holiday. And so today you'll get to hang out with me and ask some questions about things that you want to see. And I'm going to show you some new things that we're working on. And let me go ahead and just kind of share my desktop here. Groovy. All right. And so one of the things I want you to think about is, what are some of the questions? It could be features, questions. It can be marketing related. It can be software related. It can have nothing to do with BarSmart. If that's the nature of your question today, that's cool. But if you have one, throw it out there, and I will make sure I work it in to the conversation today. As always, I like to run quickly through my intro monologue, that being the BarSmart Repay Smart software is about where mindset meets skill set. I get more excited every day, unlike most people, with the new compliance stuff that I'm seeing with Safe Harbor and the FDIC revisions to pre-qualifying and education and fair lending and the focus there, and the potential impact it's having on our industry will ultimately be a good thing. It's definitely going to change the playing field and the way that we operate. But of course, for me, it's exciting because I'm watching more and more of the language of what's going to be required for the loan officers to, again, mimic more of what happens in the financial planning industry, fiducial responsibility, making sure that you're being clear and communicating with the client what their objectives were, that you were doing best, making your best efforts to meet those objectives. And we'll go through make up a case study today, and I'm going to go through a couple of examples for you. And one of the things I want to do is talk a little bit about just how you position yourself to really come through with flying colors if you ever end up on that wrong end of the audit, so to speak, where you're having to show that you met these requirements. And I actually think it's just good business. I think that a lot of things they're asking us to do are really going to help our industry move beyond that traditional mortgage broker mentality into more of an advice industry. Again, it's never about what the software does. That's an important part of the tools. If you don't have a hammer, you can't get good at using a hammer. But once you have the hammer, what you learn to do with it, how you learn to use it, is a function of the time and energy that you invest in it. These, what we'll call these different styles and impacts and ways to converse are going to continue to have a big impact on our industry as well. I think I told the story last week about someone, having a client email them from a dental chair saying, "I just watched your presentation, looks great, let's move forward." These stories are coming in as people are looking at stuff on their iPads, they're watching things on the treadmill. These different ways of learning to communicate face-to-face and offline and online are going to be really critical going forward. And we're going to be rolling out tomorrow the first release of our new Client IQ system. And the Client IQ system is basically going to help you when you send out that presentation to a client to not only know what's happening and when it happened, when did the client view the plan, what did they actually do when they were viewing your plan, but we're mapping out what we consider to be key triggers, key activities that a client might take, and things that would be meaningful to you. Maybe, like, for example, they clicked on your website. That would be a pretty important trigger. So the system's going to automatically record that in the Client IQ, and when a major trigger event occurs, it will actually email you immediately to say, Larry Keller was just at your website viewing your site. So we're going to know that from the presentation that you sent them. And this is not a compliance call, but it's also going to be a phenomenal compliance tool because it means that you'll have a record of everything that the client has seen. If they ever say you didn't explain something, you didn't show them, you're going to have time and date stamped interactions for every single thing that they've done with you, from clicking to open and print your document, to viewing a web page, to watching a video, to clicking your email. All of that is going to be time and date stamped. So it's going to be a really very cool way for you to see what's going on. And we talked about this a great deal, so I won't spend any time on it. But one thing I want to focus on here is the 3 questions. When we look at the 3 critical questions around closing, do I have the cash now? And remember, that's just the way we've outlined and developed software. How do you explain clearly the closing, the payment? And the thing I'm changing here, wealth impact, it's the same thing, but I'm changing the labeling to affordability, because that's a lot of what we're seeing in the education, the CFPB type stuff is around the cost of home ownership. Are you helping clients understand the financial impact, the cost of home ownership of those options over time? It's the same thing as wealth impact, but I actually think it may have a more powerful resonance with the consumer. If you were to say to a client, I'm going to help you understand the closing and the impact of the cash at closing, the impact on your monthly payment, and most importantly, the affordability. What's your cost over time to own this house? If you have multiple ways that you could pay for the house, which of these is going to be the most affordable for you over time? And affordability will change. You might have a 3-year time frame, a 15-year time frame, a 30-year time frame. But I'm going to start repositioning a little bit the software, not the software, but the messaging around the software to focus on these 3 areas. Again, it's the same dynamic: closing cost, monthly payment, and wealth impact. Just tweaking it a little bit now to focus more on this dynamic of affordability. Because at the end of the day, I think if you can talk to a consumer and help them understand that you're going to show them the most affordable way to own this home or buy this house, and even if it's a $5 million home, why would you want to pay more for it than you need to? I want to keep it fast, easy, and accurate. We actually made some changes this week that actually accelerate the borrow screen pages another few milliseconds. And it doesn't seem like a lot, but we keep making small changes that just make the tool work faster. And today we're going to show you some new report formats we're working on to make it easier for you to present to your consumer. And at the end of the day, we're all about clarity and confidence. That's what we believe is important. And again, we're seeing more and more that the regulators, the governing bodies are saying you need to deliver clarity, you need to provide that client with their options in a way that help them to understand what's available, what's possible. We believe doing that leads to quick action. So you do well by others, you're going to have an opportunity to really benefit. Now, we always mention we have our YouTube channel. We continue to put short videos and training videos and these videos there. This is about our 18th installment in this series. And I always like to give you a quick update. So our Action Trigger Report Card version 1 is live. We're going to roll it out live tonight, so you'll start seeing that working tomorrow. So you should get your first updates tomorrow on any new reports or existing reports that have gone out. If a client goes and views that and they close out the window, you'll get an update or an email. But I'm going to show you where you can also see the Client IQ reports anytime you want to. It's going to be very simple. I'm going to show you next Monday or Tuesday, we'll go live with our new plan layout formats. And this is an aggregate of a few different recommendations and questions that people have sent in related to their ability to show clients visually some of the information. And I've got a good example today where you could show someone the numbers and show them the financial impact over time, but the graph actually tells a much different story as to what might be most important to them going forward. The dynamic plan interaction, we're testing that now. That's where the client will be interacting with their plan and sliding sliders. And we had to develop the Action Trigger Report Card first because that plan interaction is going to be part of that report card. Anytime a client interacts with their plan, again, you're going to have a quick email, an action trigger that says, Matt Flynn was just over at his plan and he slid his slider to pay off in 10 years. And that's something you want to know, right? It's going to let you know that they're thinking, that they're planning, and it's going to help you be more effective in working with that consumer. And I mentioned we started on our Bar Smart solution. We hope to roll out in the January to February of next year, which will be a new site that will allow consumers to come, play with these calculators and these tools, and then submit their work directly to a professional in our network to be able to help them determine what's the best borrow smart, repay smart strategy for them overall. So let's start off with just some of the updates for today. The Client IQ report. I showed you last week what we were laying out for that, and our approach is to be able to give you some updates. So this is something that we sketched out as a plan. So let me kind of show you how this is going to work in real life. So I've got Joe and Sally homeowner here, and you would do everything the same as you do it today. You know, you do the analysis, you create the plan, and then you go to the present page. And you're going to see somewhere on this page, it may stay right here, probably it may move, but it's called Client IQ. So before we had a link that had your report link to it, and now what you're going to be able to do, the Client IQ will automatically email you the triggers. So you don't have to check anything. When something happens, when a client checks a plan, when they visit your website, when they email you, it'll say, did you get an email? Because your client just clicked on the email address. You might want to check for that. Any kind of a trigger that might help you keep a pulse on what's going on with a prospect is going to be tied up in the Client IQ. So if I click Client IQ for this client that I'm working on right now, you'll notice that what it does is it opens up a Client IQ page for me. It's going to have your normal information. And this first version is that's working live right now. It'll go out tonight. It's going to look like this. So you'll see a graph here. And what this graph is going to do is it's going to be starting from the date that it was created and the client first viewed the plan. It's going to start plotting and graphing out how much time they've spent on that plan over time. So at this point, I can see on this plan, on 11/14 yesterday, the client spent basically a quarter of a minute on the plan. So they must have gotten it and just viewed it. Now, what did they actually do when they were on that plan? I can actually see over here, you'll notice that now I've got a lot of updates. Anytime you change or update a plan, maybe you change an interest rate or you modify the plan for the client, it creates a new report in the system and logs that in. We need that from an accountability and administrative standpoint. Most of the time you'd only see one plan over here, right? Maybe you make one modification to it. You'll have the first plan you created, and then here's the new plan that you just created. But what you'll notice is there'll be a check mark or a plus beside a plan that's been viewed. So these are all modifications I've made because I do a lot of changes in this plan here. But this is what you're going to see when you come into your plan. You'll see the graph of what time was the client there, how much time did they spend there, and you'll see a breakdown that shows you they opened the report, they looked at something else. Now there's a bunch of these in here. That's because I was playing around with some different things. But this is actually it's actually registering the time they spent on the report. So it says looked at something out for 1:16. That means I went away from this window somewhere else in my browser and looked at another window, did something else, and then came back. So I came back here, and it's going through and it's looking at what did you actually look at, and it's going to show you the actual tabs here. For that thing, and I'll show you some different ones if we play with them. It'll say viewed the tab, watched the video, viewed in each tab that they viewed. It will show that tab and how much time they spent on that tab. So you're going to have a complete profile of exactly what that client did on the plan, how much time they spent there, etc. You probably won't really care so much about this. So in a way, think of this as more just an archive system that's logging all of the activity. The next release that will come out probably the first of next week will have the other action triggers and stuff over here. And that's going to show all the critical things that they did that we think were really important. They interacted with the plan, they printed the plan, they viewed your website, they clicked the email link, and you'll see those lining up over here. But at the end of the day, the Client IQ report link is really something for you to go in and look at to see what they've done. But all the critical stuff is going to come to you as an email. So it's really more, am I curious enough to want to come in here and go look at this? So if I clicked on this report link, this takes me to that version of the report, all right, that I was just at. Let me just change this real quick. So if I go over here and I looked at the closing cost comparison and the repayment comparison, and this is part of what we're going to look at next, some of the new graphs and features that we're adding in here. what's happening right now is this is logging this into the system, and it's calculating how much time did I spend on this particular page. All right, and I view the loan program matrix next, and I didn't spend much time there. Maybe I spend a bunch of time on the amortization tables, and maybe I'm here for a minute or two. All right, and then I close that presentation out. So what's going to happen here from a logging standpoint, I just hit the refresh, and look what just happened on the report I was just at. So the client opened the report, they looked at something else, they looked at the closing cost and payment comparison, they looked at the repayment comparison, they looked at the loan program matrix, they looked at the amortization tables, they closed the report, they were there 31 seconds. That 31 seconds gets added here. So as we played with it, if you get, go out 4, 5, 6, 7, 8 days, you may see the first couple days they spend a lot of time on their report and they haven't been back. But what if, like one of our major action triggers is, what if they haven't been to the report for 5 days and they visit it again? Do you ever have those clients that you send a presentation, you just don't hear from them again? Well, if they go 5 days with no activity and they suddenly visit the report again, that's something you want to know about, because that means that maybe they're back to looking at it again. Maybe they got busy and they're interested. Well, if I have a client that just viewed that report today, now would be a great time to reach back out to that prospect and say, hey, I just was thinking about you, thought I'd give you a call, see if there's anything I could do to help you out. But notice now, before, there was no interaction with this report. All right, so this link is just for you to be able to go to, if you want to, the original version. So you've got every version of the report you ever created. So if you needed to go back to a report you created on the 14th at 3:12 p.m., I can go in and click on it and go to that report and see exactly what did that report look like. But what this is going to be critical for you is, as well, is you'll be able to actually see. Now, if I refresh, you'll notice what happened here. There's what we just did on that report. It's all logged in here, 10 seconds, and what was looked at. So if you had a client that went in and was looking at an old version of the report and they kept going to the old version, maybe you want to send them a new link to the updated version because you've created a new report or a new presentation for that client. Again, most of the time you're only going to have one over here, maybe two, but every time they go back to that same report and they do more, it's going to accumulate and show those activities. So if I go back now and I click on the introduction page and I go away, you'll notice now here when I expand this, here's one transaction, closed report, came back to report, opened it, looked at the introduction, closed the report. So you'll have a cumulative log of all those different activities. And over here you'll have all the key critical things that we talked about before. So we're real excited about this from an administrative standpoint. For large corporations, banks, enterprises, this is phenomenal. Not only will you have an archiving of all of your presentations, but you'll have all of the client interactivity, which will be really critical for QRM next year. But for you, as a producer, your focus is going to be more on, is this going to help me? And so unless you want to click the client IQ and go in and drill down into that particular report, you're just going to get these emails every time something critical happens. All right, so that's what we've been working on with the client IQ. You'll see some of these additional features, actions, and triggers coming online. I wanted to share that with you. The second thing that we've been working on is we've had a lot of people sort of ask or challenge us to say, could you create a one-page, really simple summary? Now, when we approach this thing, we have to think about the fact that we have 30,000 active plans in the system that have already been created. We also have all the different combinations of products and programs that we have to consider, everything from ARMs, amortizing interest only. So we build it as a model and we start testing it. So this was a simple summary spreadsheet we built. One of the key things that people ask us for is just something that's real simple that shows the loan amount, the term, the interest rate and APR, the payment. Some folks are very interest sensitive, so they want to be able to say, I want to compare just the interest paid over time, because that's something I like to focus on. And then we have our key numbers here: cash to close, monthly payment, and wealth impact, break even, and debt free. So we've taken a lot of these critical numbers to put them on one page. So what I'll show you is what we've been working on for that. So what this would be is a one-page summary. If you just wanted to show a client a one-page summary, you could click that and it would build it in that format. Now we're not through with the formatting, but we've got it all plugged in here, and the time is set up. So you could just do a summary and payment information over the next 11 years. So this is whatever their time frame is for that client. So let's say that the time frame for this client, it's always going to be off your key drivers. Let's say they're thinking about something about 7 years out. So when I go to the present page to build my report, I want to just give them a little one-page summary, and that's what I want to send them. So now you could send them, it's got your contact, all your information. Here's your one-page summary, and you could do your little video or not. And it's going to show just those key things: loan amount, remaining term, etc., your interest payments, cash, your payment difference, your savings. You're going to have your highlighted for the one that's proposed, your break even, and your debt-free in months for that particular client opportunity. So we're going to probably add a little bit more. We're probably going to go ahead and add closing costs onto this page, and we're going to make it a little bit larger text and spread it out a little bit more. But this will give you a one-page summary that you'll be able to present to a client. And with all of this stuff, I really respect your feedback. If we put it out there and you start using it and you find there's really something missing from this or something that you want to see, let us know. Now, by adding the closing costs here, so you'll have the summary, the key numbers, and the closing costs, that will allow us to then have the second page, which is going to show up as 2 pages here, but I want to show it to you. The second page will just be the payment and the wealth impact in this format, just like it was on the 2-page report, but now we're adding a graph. So I'm going to see if I can blow this up just a little bit so you can kind of see how this looks. So this is a situation where maybe the monthly impact on the 7-year and the 30-year are over here. We're showing a snapshot, right? The 7-year ARM is saving that client $755 a month. The 30-year saving $655. But when you're dealing with a snapshot, what a lot of people are saying is when they're talking to clients about ARMs, or one of the examples I'm going to show you is like a payment shock, like where the ARM is about to recast, but the client maybe doesn't really visualize when that's going to happen or how that's going to impact them. You'll be able now in this scenario to say, all right, your current liabilities are in black. So here's what you're spending today. You're spending $2,000, and this client has an auto loan that's paying off. So isn't that cool? You see that going down? Your auto loan's getting paid off here, and that's going to drop to right here. And then you've got another loan that was being paid off here, and that's going out, and they had a little HELOC that was interest only, so it's still showing a balance at 30 years. So you can literally tell the story of their liabilities with the black line. We're comparing a 7-year ARM and a 30-year. Here's the 30-year. Notice it stays right here. It's actually lower all the way across to this point. And the 7-year. The 7-year is lower all the way to 7 years. But in the 8th year, it starts going up. And depending on what your setting is, in this case, I have it set to increase to worst case scenario, it's increasing at the max caps to the worst case scenario over what looks to be like what? 1, 2, 3, 4, 5, maybe 5, 6 more years, and then it's staying there. This is really helpful. If a client says, I'm going to be in this house for 5 to 6 years, and they're focused on cash flow, it's kind of easy to tell this is a story now. Here's the payment savings, right? But here's what your cash flow is going to look like. Here's what your payment's going to look like. I'm consolidating debt here, so the debt's the same. Here you're keeping your old debt, and you're going to pay some debt off over time. But think about that in terms of how you tell the story. That's why we're going to move this up top. So the payment will be here, and the wealth impact will be below. And that happened as we started testing this, and I started realizing that it's really cool to be able to see the payment impact graph above and the wealth impact graph below. So here's your wealth impact after 7 years, and this is showing the client's going to save $47,000 versus $35,000. Because we know, right, if a 7-year ARM is lower than the 30, over 7 years, this is a better deal. But look at how this is mapping out. So what the wealth impact over time graph is going to do is it's going to baseline their current liabilities at 0. Because we find that's the most effective way to tell this story to the client. Here's what you're doing today. This is going to be your baseline. Are the options that we provide you better than what you're doing today, and by how much? So just if you knew nothing about this and you just looked at this graph, what would this tell you? The 7-year ARM, and notice it's hard to see here. We're going to make these a little bigger if we can, but you'll notice that the little line starts below zero because of the closing cost. So we're showing that negative closing cost and that break even. This is also graphically showing your break even. So the point where the borrowing crosses the black line is the point where your break even is zero. So that's really cool because you can tell the story now. Look, your break even before the first year. We saw the actual break even numbers before. It was like 5 months and 8 months. So we know that to be true. The 7 year is better off for you, not during the first 7 years, because remember over here, I could tell the story of the payment very easily. You know, this is much lower for you in the first 7 years, and then it starts to go up. But that doesn't tell me financially what's the better option for me over time. So what this does is I can actually see that my crossover point is right here in about the 10th year. So that 7-year arm is better off for me through about 10 years, and after 10 years, the 30-year fixed is better for me. And I got to tell you, as I've gone through and played with some of these case studies, I'm getting really excited about this because a lot of these numbers over here, I mean, just think about it. I find my mind going back to this graph because this is the breakout of the numbers. This is where the story is. And good selling is storytelling. And when you can sit down and show somebody a picture that explains, I don't care what you do, both of my options, even in a worst case world, are far better for you than what you're doing today. The question is, if you're going to be in this house for 15 years, then we need to stay with a 30. If you're going to be in this house for 7 or 8 years, the 7 year is going to give you protection through the 10th year to provide you the, and think of wealth impact over time. We may change this to cost of ownership or something that again reflects the fact that what this is really graphing here is what's going to cost you the most to own this home. We may have wealth impact, and you may be able to change it to cost. You can toggle different things. That's the other thing we're thinking about is you can decide you want to plot wealth impact or interest payments or loan balance. So you could pick what you want to actually plot here on the bar screen. You would just pick which one you want, and then that's what would show up on this particular graph. The other option is, and again, I'd love your feedback on this. We've got this area here. We might just do some additional graphs and charts. Such as the loan balances and stuff, just again things that you think would be helpful to show that client. But we want to keep it simple so that it's easy for you to tell the story. So where we're going to end up with is basically 2 pages. One will be the summary page, and then the second page will be the payment and the wealth impact on one page with the details here and the charts over here. So it should be really cool for again for storytelling. All right, so let me shut that down for a second. I want to see if you have any questions on this. Let me stop for a minute so I can separate out my window with the chat bars on it. And because that got shrunk down when I got kicked out earlier. Let's see. All right, let me go back to sharing my desktop. And I'll make this a little bit smaller since I blew it up way big. Okay, cool. Let's see. How do I show someone when MI will drop off their conventional loan, both if they make their current payment or their payment plus a monthly principal reduction? So when the MI is going to drop off, if you're asking how do you do that, you set your drop off here. So with each program, it'll use your defaults, so you can set your defaults, and it'll do that all the time, or you can set them manually, such as mortgage insurance would stop at 78% LTV, or if it's an FHA or VA loan, you've got 60 payments or 78% LTV if it's FHA or VA. But if you're saying, I don't know if this came in before I was showing the graphs or not, but if you're showing the MI drop off, it's actually going to show on that graph. You'll start to see that payment would dent down. It would actually show up in the little graph, which is another example of where a graph is going to show you details that would be very difficult. You would see that on the AM tables. That's another place you could see that. I've had people say, how can I show my client their MI payment's gone? And I'm like, well, you would just make sure you click the AM tables button when you're building the report, and then you can actually show their current liabilities and then their proposed liabilities, and you'll actually see where the payments, the total payment that's being made for that particular year, interest or whatever, will drop off. But I think these graphs are going to be great for that kind of conversation, because you'll see those little dents as they drop down. Let's see, Larry Z. Okay, so that's something else. I'll let her answer that for you. No, nothing. Okay. This is really going to cut time. Get quick answers to come. Key questions to my prospects. Thanks, Arthur, and thanks, Randy, for your comment. Can you illustrate pre-tax and after-tax numbers? Absolutely. So, and I'll jump around here on some case studies. I'm going to go through a sample one for you. But remember, pre-tax or after-tax is one toggle. So when you're doing your plan and you're setting up your scenario here where you've got your current borrowing and their proposed borrowing, in this case a 7-year and a 30-year, then we go into our 3 critical questions. What's the closing cost or the cash impact at closing? What's the payment impact? And you can decide if you want to do your payment pre-tax or after-tax. If you expand this button to show after-tax, it assumes after-tax is your default format, and all numbers, all materials, all presentations, everything in the entire presentation will be done on an after-tax basis. So we did it that way so that you don't end up showing pre-tax one place and after-tax somewhere else. So you decide, am I showing pre-tax numbers for this client? And if I do, I just expand this. It's going to show the after-tax payment and the after-tax savings, and all the numbers below for wealth impact are going to all include right here tax savings. All that's going to be factored into your analysis for you. And if you decide, I just want to go with pre-tax numbers, you do that. You'll notice all the tax savings is gone here, all the reports, everything is disappeared. So it's a one-button decision. Do I want to show tax impact, or do I not want to show tax impact on my analysis? Let me see. I saw another question come in there. I had a client that had a second mortgage at a local bank. It was split into 3 loans. Basically, they would charge X amount, then opt to line of credit over a fixed period of time. I had a problem linking these to the subject property. Any advice? So you'd have to create 3 different loans in the system, then opt to line of credit that balance over a fixed period of time. I might have to ask you this. That one seems so complicated, Mike. I'd have to maybe get more information from you, which I've tried to do that in the past, and it gets real confusing because I need to ask you questions. So maybe you could send me, if you want to send me your client name, if you tried to set it up and say it was the Smiths, then I can log in as you and take a look at it and see if I can help you. But most likely on your manage page, when you're setting up your loans, you'd have to set up 3 loans here for the different line of credits. But it could be a little bit confusing. I'd have to kind of think about it a little bit. We have been. Let me go through a case study, and then I'll just do one from scratch, a simple plan from scratch, and talk about some of the new guidelines, and then we'll talk about some marketing ideas and stuff like that today. So this one came in. It was a pretty neat case study. It actually forced us to go in and tweak a couple of things to be able to handle it. But the question or the situation was a HELOC reset. So let's kind of walk through the situation. It was a refinance loan, and the client had a HELOC that was going to be resetting in a couple of years. They have $200,000 a year in income. They were in a 25% tax bracket. All right. And so this is the current setup here. They got a mortgage, 30-year fixed with Bank of America, 4.4% fixed. I'm refinancing right now. You're seeing a lot of that stuff going on right now. A lot of people in the 4s are finally starting to pull triggers and refinance into the 3s. But this client had a 4.4 here. They also had a second mortgage. It was a HELOC, had a 10-year draw with a 25-year term, and it's currently at 2.25%. At a balance of $160,000, and they're paying $301 a month. So, again, when you set these up, you just put in your product type here, and you set up your starting rate, your first adjustment, your life cap, your margin, prime plus 1, whatever the case may be. If you can set up how you want it to be there. And this is something I want to talk about in a little bit, the custom rate simulation, because this has come in quite a few times. The guidelines require, if you're selling an ARM or marketing an ARM, that you do a worst case scenario. All right, but a lot of us know that it's very unlikely that the mortgage interest rates are going to go from now straight up to the cap as fast as possible, even though technically we're supposed to disclose a worst case scenario. So what I want to show you in a minute is how, if you're showing an ARM, you could show a client a 7-year ARM with worst case, which would give you compliance, right? And then beside it, do what you expect to happen, a custom simulation like this one. This advisor wanted to use index staying the same for 2 years, then going as high as 6% at about an annual rate of 1% per year. So you can actually set up a custom simulation, as well. You don't have to use worst case. But so that's the setup. I mean, pretty simple scenario, right? You got a client, they have a house with a 30-year fixed and a HELOC. They've got about 388 in fixed and about 160 in variable. But that rate, which I think was a teaser rate because it was 2.25, it was prime minus 1, I believe, when they took it out. It was about to adjust to prime plus 1, and the loan was going to recast in that situation. So when I go to the borrow page, how would I set that up? You got their current borrowing, 584, 3.773 pre-tax, 2.82 after-tax, total payment 2289, and notice they got 344 months left on their mortgage. This is no term right here because they're still paying interest-only payments. So until those payments go up dramatically, that loan's not going to get paid off. So here's what the client wanted to look at. They wanted to look at a 10-year fixed with HELOC and going sort of the route of paying it off very quickly, or a 30-year fixed and with a HELOC. And why HELOC? Because they didn't want to go over 80%. So what this loan officer did is he set up a 10-year fixed at 80%, which is 496, and showed that at 3.25. And then it did a new 1025 at 52,244. That's the balance at 4%. And again, when you set this up, so when you set up any kind of an ARM, you have that ability to come in here and set up the caps. And we use the same assumption. Custom rate simulation stays the same for 2 years, then goes up as high as 6% over 1% at a 1% increment. So this is how it's going to model this scenario for this particular client on the HELOC. On the 30-year fixed with HELOC, same scenario, same LTV, 496. The only thing that's changing here is a 30-year fix, so you got a 4.25 rate. Why 4.25? Because it's a jumbo. So one of the things you can already see, right, is that their after-tax rate here is 2.8. Here it's 2.4. Here it's 3.1. So their actual cost of borrowing is going up a little bit here, but that's partly because the first mortgage is going down only a little bit from 4.4 to 4.25. And this is going to 4%, and of course that's going to be variable, but it's a lower amount. It's not 160, only 52 of it. So this is a big difference here, 3.25 versus a 4.25, but that's what this loan officer was working with. Now, in this kind of a case, you got closing costs, right? They're going to be the same either way. So they got $7,000 out of pocket. They've got to come out of pocket for. So if you were answering this question, if you were addressing this with the client, you would want to know what is your goal with closing costs. Are you okay paying those closing costs? Do you need to have those paid for you? What are your options? In this case, client said they were okay paying closing costs. So they're going to have $7,160. So closing costs is sort of irrelevant at this point. Payments. So they're currently spending $2,290. Their new payment would be $5,021 per month if they wanted to pay this off in 10 years. The 30-year fixed, okay, would go to $2,614. So again, what I'm kind of leaning towards here is does this really tell us what we need to know? Well, it tells me something, but I know I've got a fixed and a HELOC and a fixed and a HELOC. What I really want to know is what's the financial impact over 10 years? So we can see there's a big difference here, right? So over 10 years, if I just make the minimum payment, $2,290 or $5,021 or $2,614, I can still see that where am I at? I'm going to be better off by $118,000 over 10 years with a 10-year fixed with HELOC scenario versus the 30-year, I'm basically about break even. I'm not that much better off over 10 years with the 30-year with a new HELOC. I mean, I'm better off, but my net better off is only about 13 grand. Now, if I were to change this and go out, say, to 30 years, 254 versus 42. Again, you're actually losing some ground here. Again, based on what assumption? Based on this particular start rate and the caps for the new loan. This HELOC is going to drag down that savings over 30 years. So this really allows you to tell a story for that client. 7 years, 10 years. Which of these is better? Can you handle the higher payment? Now, what I also want to point out is now if I go to the new format, and I did this, I'll just click the what we have up there today. So here's my summary. Break even's 33 months on this one, 13 for this one. So I can highlight my savings, 118 versus 13. But I found this was really cool to start looking at here, because now this is where I think you really start to see how it's much easier to tell this story in a picture. Here's their current liabilities today in black. This is what they're spending today, but you'll notice here it goes up a little bit, and then you've got that HELOC recasting to the higher prime plus 1, and you've got that being paid off over the next 15 years, and then it gets paid off, and now you're back to just your first mortgage, and then it gets paid off, and you're paid off in 29 years. Here's your 10-year fixed with HELOC. You come over to here, everything's just about paid off in 10 years, and then you drop down to your minimum HELOC payment, and HELOC's paid off over here. Now, obviously, this is because I've got it set to minimum payment. Remember, because minimum payment is just going to say you only make the minimum payment required by you. So this is graphing their minimum payments. Because once this is paid off, I don't have to pay. Once the mortgage is paid off in 10 years, the HELOC doesn't have to be paid off until 25. So it's showing that HELOC. I misspoke. This wasn't the HELOC. This is the first. Here's their 30-year fixed with HELOC. This is the minimum payment they have on that going forward. So it tells a different story. If I go to repayment comparison, here's the same scenario we talked about before, but now look at the graph. These two options both start below here, but here's the wealth impact on the 10-year fixed with HELOC. Here's the wealth impact with the 30. Notice that it's really flat, and then they actually start to lose ground based on the higher rates of the HELOC and that interest compounding over time. So it's easy to see here that 10-year fixed with HELOC is really going to be a much better scenario for them based on this scenario. Now that's based on the way it was set up. How could we set it up differently? Let me come back over for a second. And let's say that in this scenario, we wanted to focus on fixed at the minimum payment. So fixed at takes the highest possible payment and assumes you apply that to all three mortgages. Because that's the only way to be fair. If you're going to look at the wealth impact in each scenario with one click, and I click the fixed at, it says, how much would you spend? If you can spend $5,021 on this, you can spend it on this. You could spend it on this. So the software is going to then equalize the payments and say your payment's going to be the same in all three scenarios. What would the wealth impact look like then? Well, over 10 years, you're going to save $50,000 versus $30,000 compared to what you're paying today. So that's a big difference. I mean, I got to compare apples to apples. If I can pay this amount of $5,021 on a new 10-year mortgage, I could keep paying. I could pay that today on the existing mortgage with no change. And these are questions clients have. All right. These are the kinds of questions that they have in their mind. Well, if I'm going to pay $5,000 a month, why don't I just pay that on what I've got today? You could do that, but you're going to still save $50,000 if you go with this at the lower interest rate for your first and your second. You're going to still save $30,000 if you went with the 30. But just by changing that one thing from a minimum payment to the fixed payment, again, what I've been having some fun with today is just going over and saying, how does that look graphically? What would that look like in that situation? So I come over here and I can look at the payment here. I can look at the current liabilities. We're still graphing their minimum payment here. And then I can look at the wealth impact. So the wealth impact is different now. Here's my closing cost that I'm paying out of pocket. It's the same for both. All right, but I can actually see if I'm making that larger payment, I can see something kind of interesting there. The 30-year is actually better off in the 21st year. I wouldn't have expected that. But just based on the time value of money, the amount that's available, where it's being applied, this is going to go through and calculate those crossover points for you. So it really does tell some pretty cool stories. Let me check, and I'm going to go through and just run through a sample and show you an example real quick of the of how you could create an ARM plan for a client that's kind of got the compliant approach to it, but also allows you to do something that's a little bit unique. So let's say you've got a client and they're purchasing a house, and they're buying the house for $250,000, and their name is sample client. I'm gonna do this in real time. Like $150,000 and a 30% tax bracket. If you don't know what the tax brackets are, just click the cheat button right there next to it. Here's your current tax brackets. Okay? And let's say all I want to do for them is model this purchase. I'm not going to compare it to anything. I'm not going to compare it to renting or anything. They want to look at buying a house and see what it would look like. So I just go to the borrow tab. Well, we got 4 fields so far. I come over here. It knows there's no current liabilities. So I want to show them a 7-year ARM. All right. So I go over here and I find my 7-year fixed ARM, and I'll do 80% LTV. That brings in this, and let's say I like this, but I'm going to change it 2.75, and I'm done. I've just now, with what that was maybe less than 60 seconds, I've set up a purchase scenario for a client buying a home, and I've shown them a 7-year ARM at 80% LTV, 200,000, 2 3/4. My presentation's done. It's going to have my default closing costs. It's going to have their down payment. It's going to have their monthly payment all calculated with all my defaults. Here's my principal, taxes, insurance, and stuff. And it's going to go through there and look at the cost of home ownership over time. And I'll come back through that in a second. What I want to do, though, is I'm going to have this ARM, okay, with my ARM default. See, they're all loaded because I set those up. Increase to worst case is my default. I want to duplicate this and do a different simulation. So all I click is duplicate. I'm done. Everything has been brought down here. So I just took everything here and I brought it down. If I just did this 7-year ARM, I'm going to call this expected. So we'll call this one worst. Right? So here's a 7-year ARM worst case. This one's going to be expected. So I click on this 7-year ARM. Everything's the same, but I'm going to do a custom simulation. And what I want to do is say I think rates are going to stay the same for about 2 more years. Then I think we'll go to about 6%. The index. So this is the index right now. So you got your live indexes right here. So I can look at, this is prime. I'm sorry, this is LIBOR. So 12-month LIBOR is at 0.86. I think this index could go maybe up to let's say 4.5%. I don't think it'll get there any faster than 1.25% per year. So I've just taken the same ARM. So this is my worst. This is what I have to do. I have to show a 7-year ARM with as a worst case as part of my presentation, but that doesn't mean I can't also show some better solutions for the client. So I want to show what I expect to happen, something that's more realistic. Maybe it's based on your history with ARMs, or you pull out an ARM chart showing the national average has been X, Y, or Z, or whatever the case over some period of time. I hope my internet's not going out again. Hold on one second. It just froze. There we go. I had to refresh. Okay. So now I can go through, and for this client, again, we're talking about just a couple of seconds here as I narrate it. I can see the front ratios are 9%, so they're good on their front and their back ratios. Closing cost impact. Come on, internet. We're having a little storm here, but I wouldn't think it would cause as big a problem. Okay, so my closing costs, you're going to have 52.2 or 52.2. If I want to tweak those at all, if I want to do a seller credit or anything, I can jump in here and edit my defaults. If I want to show in a 0.25 origination, all I got to do is hit that button real quick and just add in a quarter extra for this one, right? So now it's 52.7 versus 52.2. So that's my closing cost. Do you have the cash? Can you do that? Let's look at the payment difference here. In the worst case scenario, you're at 1076. In the best case, or the expected, you're at 1076. Why? Because that's your interest rate. That's the start. Nothing happens until the 8th year with this anyway, right? Randy asked about after tax. I just expand the after tax button, 876 or 876, and now we're going to do everything on an after tax basis. And then let's just go in here and look at 1076 versus 1076.9. So we're going to make sure they make the same payment on either. All right, and we go out 7 years. So we got no difference in the first 7 years except what? 466. This is better off by 466. Why is it better off by 466? Well, because at closing up here, you spent how much extra? You spent an extra $500. So it's going through and adjusting that and looking at the tax impact and saying it's about 466 difference financially over time. What about over 10 years, or let's just say 12 years? Is that difference going to get larger? Absolutely. So now you can see the difference here between a 7-year ARM with a worst case scenario and a 7-year ARM with what you've expected to happen. You're better off by 25,133 based on the assumption that the index goes up to about 4.5% and stays in that range over, say, after 2 years of staying the same. So again, I've got this is worst case, this is best case. If you had an existing scenario, then you can plot your existing over here against the 7-year ARM worst and 7-year best and kind of say, this is what I think is going to happen, but this is probably as bad as it's going to get over your time frame. And let's just say that their time frame is, we'll say it's actually just 10 years. So now, again, if I go to, so I've, again, a few clicks, got my bar scenario done. I go to the Present tab. And then on the Present tab, let's just see, because again, I'm enjoying playing around with this myself. Let's see what it looks like here. Here is your payment difference. So look at the payment. Here's your 7-year ARM. It's exactly the same for 7 years. And here's our 7-year ARM, goes up to that index, caps out at that new index here. Here's the worst case scenario where it goes all the way up to the top. So that's easy to understand graphically. And when I look at the wealth impact here, remember, the left side is always your baseline. So if you're showing a 7-year ARM against alternatives, whatever you show in the left is your baseline scenario, and then you'll compare that to your alternatives. So that way it's really easy for the client to see, so this is my 7-year ARM. It doesn't get better until when? It doesn't really start to get much better until about the 9th year, but then it really has a huge impact over the next, over 30 years, because you're seeing the compounding of that wealth impact over time. At the 10-year mark right there, you'll notice you just got a little bit of a lift here, and that's that 79.64. So I can see it right there on the graph. One of the things we're looking at doing with the graphs is whatever your time frame is, if it's 10 years, we're going to plot that on each one of these little lines, so you'll be able to see based on your target time frame where that's plotted right here on the graph for your story. All right. So let me kind of wrap up, and I'll see if there are any questions that I missed there. One marketing idea that I want to share with you, and this came in from a loan officer in California who's having a lot of success with this. His weekly project has been to go into his LOS, and he goes in and enters 5 prior loan closings into BSA. He says it just takes a couple of minutes, because all he's doing is he's going into the Manage tab, and he's creating a new client plan. So he's clicking Create New Plan, right? He's putting it in as a liability review, because what he's thinking is, I'm going to send this as a presentation to my client. So he creates a liability review, all right? And then he puts in Gustafson Review. So that's the client name. And he's got 2 screens, right? Most of you guys probably have 2 screens now. So on his left, he's got his LOS, and he's just going John Gustafson, and the income that had in there before was $98,000, and he's in the 30% tax bracket. And then he's putting in the email, johngustafson@yahoo.com, right? Doesn't need any of this. He's already got that somewhere else. Then he's putting in their liability from their last closing. Because some of you guys, with the larger institution clients, things like that, we're going through and we're creating syncs for LOSs for Calyx and Compass. But, he was just looking at a way to start really using this tool as a prospecting tool. So all he's doing is going in there and putting in their closing, putting in their mortgage, and going in and setting it up. Just putting in the closing date, the interest rate, the balance, the payment, because he's got all that from the prior closing. Taxes, insurance, etc., and clicking Save. So think about that. If you just did 5 of those a week, this part is only going to take you probably 2 minutes per client record at tops. Then he's going to the bar page. He has it set up as template. So he's got in all of his products and his interest rates and stuff. And so this is pretty much completely done for him. He's got a template he set up for a 30-year, and I think he's doing like a 30-year and a 7-year arm. So he's got that all set up in a template. So he's just basically bringing that in using the same thing each time, but it doesn't take you but a second. You could just go in here and click on 30 and 7. And then what's he doing? He's going to the Present tab. He's clicking the Presentation Wizard. So he's got his default set up for cover and two-page summary and loan program and amortization tables, whatever he thinks is important. He clicks the Launch Presentation Wizard, and then he's going in and clicking the Publish button and clicking Yes, I'd like to publish with a video and doing a recording and sending that link out. He's getting about 50% response rates from the clients. So if you did 5 plans a week where you just put in 2 minutes worth of data, put in the current interest rates, did a quick recording, so you're talking 5 to 10 minutes to get one done. You could do 5 in an hour. Do that every Monday morning. He's getting 2 to 3 per week are responding to come in and talk to him or to discuss a transaction for refinance. That's an incredible response rate. But what are you sending them? You're not sending them a card. You're sending them a presentation that they can go through and look at and watch your video and say, wow, John, this is going to save you a lot of money. I just went through your old plan. I can show you how with no out-of-pocket, you could basically pay off your house 7 years sooner. Take a look at tab 3. I really want you to see that, where you see the repayment options and how much this is going to save you. Give me a call. My number's above. Click on my email. Visit our site, and let's get together and talk. So that's a really powerful idea that I want you to think about. If you have 200 clients right now, and maybe you've talked to them, maybe you've sent a few things out, have you sent them an actual presentation using their old mortgage information and their other stuff and sent that to them in a way that they can say, wow, this is something that we got to take a look at, honey. All right. If you have any questions, feel free to send us an email or an update. If you need anything, let us know. If you want to talk to Scott about setting up a trial or your company, we've had several people using the platform that their companies are looking at it now because they need to have a more compliant sales solution and they're looking for these things internally. Please let us know if we can help you out there. I'm going to check because I know we're over by a minute or two. I want to make sure I have any questions that I haven't answered yet. I'll try to address those. But I really challenge you this week to go into your database, pull in 4 or 5 of those clients and build a plan and send it out and see if you can get a couple of new fish in the boat that would profit from your experience right now. All right, that's it. Let me just look and see if there are any questions here. For refinances and purchases with loans greater than $1 million, do after-tax values assume that all interest deductible? I have not done that, and I haven't done that manually because I'm concerned that the MID stuff, mortgage interest deductions, may change. You can go in and do it. I say I haven't done it, but actually I may have done it. I may have had Tad take that out and phase it out of $1 million. I got to check. At one point we were going to go ahead and just write it into the code so it did it automatically. Another place we were going to have it be optional, and I can't remember where we ended up on that, Randy. So I'll look and see if we actually just put that right in the code so it was going to do it for everybody automatically. And I'll get back to you on that one. How does the program present the difference in mortgage costs from a lost opportunity cost? How does the program present the difference in mortgage costs from a lost opportunity? Okay. Well, lost opportunity is really the same thing, Charles, as wealth impact, right? So, you saw that in the graphs before, but when you're on the borrow page, this category right here, let me get a one that's not blank. Let's take, see if I've got one in here. Recent one. I'll just use our old Joe and Sally homeowner. So the borrow screen, that third option, that cost of ownership or the wealth impact, that is your opportunity cost, right? So said differently, if your time frame is 7 years and you stay with what you have, this is what's going to happen. You're going to spend $171,249 in payments. You're going to have a house worth $285. You're going to still owe $176,680. You're going to have equity of $108,320. And your net impact wealth-wise is you've spent $62,929 out of pocket. That red means, it costs to live inside. I've spent real money to live inside this house, and my net wealth impact is negative. Now, if that house appreciated at 3% a year, would that be different? Absolutely. Look what happens. The house is worth $351. I spent $171. My mortgage is $176. My equity is $174. Basically, I've broken even. All right. But so we'll make it 2%. Okay, so 2%, I'm down about 20. But all this is recalculating evenly across the board. This is saying if you don't do anything, this is what's going to happen. If you go with my 7-year ARM, you're better off by $47,257. That's the opportunity cost. If you don't do this, it's the same as you walking away from $47,257 with a 7-year. That's the same as you walking away from $35,307 on the 30-year fixed. Everything's included here. Your closing costs, your out-of-pocket expense, your cash to close, your loan amount, your taxes if you're doing an after-tax. Let's look at it on an after-tax basis. One click up there. Now we're looking after tax. Everything's calculated. The tax savings is calculated 31. You got lower taxes, right? You got a lot lower tax savings on these super low interest rates right now. That's got to be considered, and that is considered in this example. Your opportunity cost is $33,397 if you don't do anything on an after-tax basis. If you don't take my advice, several people have started positioning this as the value of the advice. And that's a very valuable thing to do because people are always thinking about, what is this person making? How much money are they making? What am I paying in closing costs? I always used to tell people to position this opportunity cost as the value of your advice. All right. If you take my advice and go the 7-year fixed here, the value of that advice is about $33,397. Okay. That helps to create what? A benchmark that says the $4,000 or $5,000 you're paying closing costs isn't to me. It's going to attorneys and all these other people. But still, the value of what I'm showing you is $33,397. The value of my advice doesn't really go down, but it's not going to be as impactful. It's going to be $25,000 if you go with the 30. But that would be your choice to go with the 30 versus a 7. Based on 7-year time frame, I would recommend that you go with this loan here because that's what we're going to save you. And that's guaranteed, right? Because it's going to be fixed for 7 years. So hopefully that helps a little bit in terms of positioning, but this really is your opportunity cost. You can call it cost of home ownership, wealth impact, opportunity cost. Really, we're talking about the same thing. Am I better off taking one of these options here compared to doing nothing and staying with what I'm in today? All right. So if we add in my hiccup there with the internet dropping, we're at exactly an hour. So I want to be respectful for your time. Do hope, would appreciate your feedback. Email me, chat. If you've got any ideas based on what we sent, you'll see the Client IQ reports operating as of tomorrow. You should see the new graph page choices showing up on Monday or Tuesday of next week. And then about a week after that, after the holidays, you should see the new client interactive report features online, which I think you guys are familiar with that conceptually. But when you create a presentation for your client and you send that to them, they're going to have the ability up here. There will be little sliders, right? These sliders would show like extra payment, time frame, appreciation. So these sliders will be dynamic, and they'll be able to change the assumptions, and everything on the reports will automatically recalculate for them, so they can now interact with you on their presentation. How many times have you wasted time because a client, you sent a plan to them, and they said, well, what if I paid an extra $100 a month? And what do you got to do? You got to recreate everything and send it out. Well, they'll be able to slide the slider, extra payment slider, slide it to 100, and everything on that page that's affected by that will change. The payoff date, the wealth impact, it's all going to be changing dynamically. And the second they do that, when they close this page like I'm doing right now, when I hit the close button, you're going to get an email telling you exactly what they did. All right. So wish you the best. If you have any other questions, I'll hang out here for a minute and answer them via chat. Do appreciate your time today. Hopefully you picked up an idea or two that help you profit from our experience. And as always, we appreciate your patronage, and let us know how we can make the product better for you. Have a great day.